Good afternoon. My talk today was about the last inflation cycle and monetary policy of different small open economies, SOEs. And what we show is that while there are a lot of commonalities in business cycles and inflation and monetary policy cycles, there's also a lot of variation in how different central banks work their policy. And in particular, we focus on this last cycle. What we show is that this different variation can be often attributed to a whole bunch of factors that I'll list in a second. But first, we show that when the Fed raises rates and lower inflations, that has an effect on the small open economies by lowering PMI, by lowering affecting commodity prices, and by actually lowering inflation in the US, which in turn affects the inflation in these small open economies. So the question on the table, in some sense, is why don't some of the small open economies utilize the fact that monetary policy in the US is affecting them and perhaps wait a bit to use the headwind of the Federal Reserve? Because we show that at least for a bunch of these countries, those that moved after the Fed, their inflation has declined in a faster way. The answer to that depends on a bunch of factors. Some of the countries, some of the small open economies had huge exposure to the energy crisis following Ukraine-Russia. Some of the countries have very different food inflation. So that's one factor. The other factor that we show is that actually fiscal stimulus during the COVID event has left different effects on different countries, and that also creates different policies by the different central banks. The third argument is the credit market, and in particular the mortgage market across countries is different. In some countries, the mortgage market is primarily variable rate, and that means that if the central bank raises rate, it immediately affects people's payment, and monetary transmission is much faster. And in some other countries, the mortgage market is in fixed rate, and therefore it's less potent, and that creates different timing and different level of the extent of monetary policy by the country. The fourth factor is the exchange rate. For small open economies, the exchange rate is very important. We know that when the currency depreciates, that ultimately has an impact on inflation. And what we show is that countries that during COVID and exiting out of COVID, their currency had depreciated a lot, actually moved quite early. And those that their currency had appreciated had more room to wait. And when you take all these factors together, that seems to be a set of factors that explains the behavior of the small open economies around the last cycle of monetary policy. I want to thank Boris for, first of all, inviting me the conference, and congratulate the Croatian National Bank for the 30th conference. It is absolutely both intellectually stimulating. It provides an excellent combination of research and policy mix with a very good and contributing audience, both from the policy sector, research sector, and the business sector. I want to thank the team, the bank, and Boris for creating a great conference in an absolutely astonishing venue with both great intellectual impact as well as great hospitality. Thank you very much.